بسم الله الرحمن الرحيم. اليوم نكمل في شابتر 4 اللي بيحكي بالفاينانشال اناليسيس. طبعا هاي المحاضرة الأخيرة في قبل عيد الأضحى، فنغتنم الفرصة ونقول أضحى سعيد وتقبل الله طاعتكم وأضحى مبارك زي ما بيقولوها إن شاء الله، وربنا يتقبل طاعتكم، وإن شاء الله تكون عيديات طيبة وذبائح طيبة إن شاء الله. طيب
الامتحانات ان شاء الله تكون طيبه
اكيد ان شاء الله. طيب this is the flavor of عيد. this is the flavor of عيد. هذه يعني زي ما بنحكي حلويات العيد ان شاء الله.
ان شاء الله تكون ذاك الحلويات.
طيب حنحكي بالcommon size analysis. في two types of analysis. We have two types of analysis. The common size analysis and ratio analysis. هدول the most common analysis اللي هو common size، وعندنا ratio analysis. Common size analysis is like standardizing analysis. نسميه sometimes standardizing analysis. Is like this. What it means is standardizing. Yes. Into percentage. You are right. But why we are using this? Between two.
Inside the firm or outside? To compare the firm inside to the other parts of the business.
Yes.
And outside the other even.
Yeah. So why we are using standardizing? You are right. Yes.
Because there is a firm that large.
Yes.
And there is a firm that is small.
Yes. So this is why standardizing. Both of you are right. As you said, standardizing the ratios within the business, and comparing the ratios of this business with the others. For instance, if we have company A and company B, and company A has total assets 3 million, and company B has total asset 20 million. So it is unfair to compare company A with company B, because company B is larger than company A. So what we can do then is doing standardizing, or doing common size. Common size is like we account for the size of the business. Okay? So we account for it means بنحيد دور الsize. So it's like we compare between two business. Doesn't matter what is the size of this business by doing the common size analysis. And it is very simple. This type of analysis is very simple. The importance of this analysis is to check the contribution of each item in the firm. So what is the importance of the current assets? What is the importance of inventory? The importance of cash? The importance of the fixed asset? The importance of the current liabilities? So we see what is the importance of each item in the business. So this is the importance of this. For instance, if we have company A again and company B, and look at the cash, is here 300,000 and here is 2 million. Okay, so what do you think? B has higher cash than A, but we cannot judge on this. We will see the contribution of cash in this business and the contribution of cash in this business. For instance, if we have the contribution is divided the 300 divided by the total assets, and here is divided by total assets, and we find here is 10% and here is 3%. So it means the contribution of the cash in the business is 10%. But here is the contribution of cash is only 3%. So it means this business has more liquidity than this business. So this is the I. But if we have just this figure comparing with this figure, so we have misleading, because the figures cannot give us the contribution of each item in the business. So this is why it's important to study the common size statements. Before going in depth, I forget to say something regarding what is the importance of studying financial analysis. So what is the importance of studying financial analysis? The importance of studying financial analysis for the stakeholders. So what is the importance of studying financial analysis? Is it important to do, Khulud? This is from employees' perspective. Yes, okay. Is important the financial analysis for other people? As you said, for the employees. For investors. Yes. Yes, what the investors are interested. Investors. Why the investors are interested? Yes, investors, right. Why?
To see if the performance of the company, if they make a profit, is it safe to invest in this company?
Yes, to maximize the. Okay. Okay. Other people are interested.
Banks to give the company.
Creditors. Yes.
Suppliers.
Yes. Suppliers. So, how you answer this question is looking at the stakeholders. Stakeholders combine the internal stakeholders and external stakeholders. So the internal stakeholders includes employees and managers. You should tell us why employees are interested in the financial analysis, why managers are interested in the financial analysis. Okay? For instance, the managers are interested in taking financial decisions, investment decisions, how to allocate the resources. This is important for them. Employees are interested to see their salaries, to see their rewards. Okay? If you talk about the external, suppliers, investors, customers, we have governments, creditors, treasury groups. Okay, so each one has its interest on the business. If you talk about the government is interested in the taxation.
Yeah.
The treasury groups are interested in the health and safety, whether this business is providing a health and safety or a health and safe products or not. So this is the importance of the treasury groups. If you talk about the creditors are interested to see the business can recover their credits on time or not. Okay, so each one has the interest. Okay, this is the things that I forgot to say. Okay, so let's go back to the common size. So how we can calculate the common size is just for the income statement. For the income statement, just divided each item by the sales. If you have the income statement, so you have sales or turnover divided cost of goods sold, then gross profit till net income here. So each item divided by the sales. So you started here by 100%, then divided by sales, and so on. So each item, and I showed you in the financial analysis how we can do this in the financial analysis. Very simple. For the balance sheets, what we can do in the balance sheets, we have here the current assets. Let's see, cash, inventory, account receivable. So this is the current assets. Then the equipment, machines, building. So we have the total assets. Okay, and here is the account payable. Okay, short-term notes. This is the current liabilities, long-term liabilities. Then equity. total liabilities and equity. Okay? So each item divided by the total assets. So cash divided by total assets, inventory divided by total assets, account receivable, account, and all of them. And the same divided by total assets, current liabilities, all of these accounts are divided by the total assets. Why? Because you see, let's answer your question. Why in the income statement? The income, because the main source of income is the sales. This is why. For the balance sheet, the total asset is the main issue, or the main source of the strategic activities, and operational activities is the total assets. It includes the operational and strategic activities. So this is why. Okay. If you look at here, this is example of the Boswell company. If you look at the sales, is 100%. Cost of goods is 75 minus 75%. And the gross profit is 25%. If you look at the cost of goods is high, 75%. What it means? It means $1 in sales cost 75 cents. We prefer the cost of goods to be less, and the gross profit should be high. So the markup مكمل is 25%. Just this plus this. The markup 25%. So the gross profits, if you look at here, the gross profit is 25%. What it means? It means $1 in sales generates 25 cents as gross profits. So this should be high. Why? Because the other accounts depend on this. Yeah. Depend on the gross profits. So if you have business, company A and company B, this is 25% the gross profit, and this is 40%. It means this has more room for expenses, but this has less room for expenses. So here the company is not addressing itself in the expenses, but in this company, the company may stress themselves in the expenses because you have just this space for the 25%. The main source of profits is coming from the gross profits. So if the gross profit, if you have problems in the gross profits, this problem may leak. You know what means leak? May leak to the other business activities. So if you look at this 25% and see the total, the operating expenses, it is 14%. Then comparing with the net income is 7. It's like you see this number is keep diminishing. Okay, so 25%, 14%, 7.6%. But if this 40%, you see this is 14 is like this is doubled. Yeah. So 14%, this will be, for instance, 25%. Then this will be maybe 15%. You are here, you are more relaxed than in this business. But this business is fine if you consider another business having 10% as gross profit. And so now you don't have rooms. So if you go just 5%, then you may go in minus 10%. Because expenses eat more from the gross profits. Yeah. Okay, just picture this problem. Okay? Okay, so selling expenses represent 3% from the sales. This is 2.5. Operating income is represent 14%. Is just deduct this from this, you having this, the expenses. If you deduct this from this, you have this expenses or these expenses. This is because sometimes the question is not coming like this. It's coming like this. Okay, so be careful. Okay, not always, just 10% of the questions. Okay, so you should be, you should understand how these calculated. Okay, this is for the balance sheets. Look at the balance sheets. If you look at the balance sheets, first look at the current assets. Total current assets in 2009, 27%, 32%. Okay? So it's growing up, which is fine. Okay? It's contributed is like 1/3 of the business activity is concentrated in the current assets. يعني ثلث البزنس بتركز بالcurrent assets. ففي عندهم operation عالي هذا الشركة. Compare this with the current liabilities, and this must be greater than the contribution of the current liabilities. Okay, so go to the current liabilities. Total current liabilities is here. Look, compare these two items. So 27%, 16%, yes. So approximately is doubled, approximately, not the, which is fine. It's around 1.9 or see 1.8. 32 is getting much better here in 2010 compared. So this is reduced, which is fine, and this is increased. This is what we want. Okay. If you look at the change here is improved. This is decrease, which is this is optimal position for this business. Okay. Okay. Let's go to the fixed assets. To the fixed assets. Here the total assets. So here is the fixed assets. Net plants 73% and 67%. Now my question to you. Is this company is manufacturing company or like services company? Yes, because they depend on the fixed assets. They depend. If you look at Google, for instance, or if you look at it is services, so you will see the operational level is higher than the strategic level, or the operational expenses, like the salaries of employees, is higher than any other items in the business. But here, look at, it is around 73% is investment in the fixed assets. And here 67%, so decrease in the, so here the business may sell or could sell some machines or equipment for some reasons. Okay, so this is the idea of the fixed. If you compare this part, this fixed assets, with the long-term debts and equity, total common stock, this one, so again, it's higher. It's higher. Again, it's like stress the light on the importance of the fixed assets. So if we liquidate the fixed asset can easily cover the long-term liabilities. So here 73%, here 40%, 67%. This is 39%, and this is the change. Now this is the importance. So this business is secure, is safe. We may not face challenges in the near future. Okay, this is the way how you judge on the business. Okay, let's go back to compare within the liabilities. If you look at the liabilities, the total current liabilities, we have 16%. Just compare this with the long-term debts. It means this company generally depends on the long-term finance, because this area is finance. 40%, 16%, 40 with 14% is like the long-term investment. Why the long-term investment? Because we are, why the long-term finance? Because the fixed assets. So this business is conservative because they are funding the current assets from the current liabilities, and they fund the fixed asset from the long-term debts and the equity, this is very important to the business. And again, for the total common, look at the 40%. Look at these two areas. Compare with these two figures. The long-term debts, yes, and the common stakeholders. Approximately, this business depends 50-50 into the total long-term debts and equity. So it's like 50-50. Again, this business has, to my point of view, has no risk or minimum risk, because see, the common stockholders' equity is 42%, 40% here is more secured, because 46% and this is 40%. So this business is stable, fine. From the first analysis, we can judge on the business is fine. From the first analysis. من أول نظرة عملنا تحليل بسيط. هذا زي ما أنتوا بروح الواحد بيعمل تحليل بيشوف التحليل المبدئي. This is يعني first scan. التشخيص الأول. بعدين okay. If we have issues, we go in details. هدول كلهم التحليلات بنقول فيهم ال common size analysis وال ratio analysis just for scanning. شوف تشخيص أولي. بعدين ندخل على التفاصيل بتاعة الاناليسيس. Any question? Any question? Okay. So we talk about this observation. Now, using financial ratios. Even I give you more details about what the book say. Be careful for what I'm saying, because what is in the book is limited to the book. What I said is more than what the book saying. So using financial ratios. Again, the common size analysis giving the first point of view about what is the reality of the business, and it gives you some weaknesses and strength points, but so far we don't have a particular issues in the business or a particular challenges in the business. The financial ratio analysis giving you more details about the specific issues in the business. Okay, so in the financial ratio analysis, it includes different analysis or different types of analysis, such as the liquidity analysis, liquidity ratio analysis, the capital structure ratios, asset management efficiency, profitability ratios, market value ratios. It's like divided the business into layers, into activity, and evaluate these activities. So, for instance, how liquid is the firm will be able to pay its bills, I mean the current liabilities, as they become due. This is measured by liquidity ratio. How has the firm financed the purchase of its assets? This is capital structure. Is the long-term debts and the equity is measuring the finance. How efficient has the firm's management been utilizing its assets to generate sales? This is asset management efficiency ratios. Then has the firm earned adequate returns on its investment? This is profitability ratios. To what extent the business is profitable? So it's measured by profitability ratios. And the last one, which is the important one, are the firm's managers creating values for shareholders? This is the most important one because it is much related to the firm values or the maximizing the business values. So there are the main categories of the ratios: liquidity, capital structure ratios, asset management, profitability, and market value. Okay, let's go one by one. Let's start by liquidity ratio. Liquidity ratio analysis, it measures to what extent the current assets covers the current liabilities. Liquidity is the ease of business to convert current assets into cash without severe implications on the price, okay, or without implications on the price. And I gave you 2-3 classes before, example of Samsung and Ericsson. Samsung is easy to convert into cash. Ericsson, maybe you may face some challenges on the fab. And the liquidity ratio analysis including 2 main parts. Giving you the general picture of the liquidity. Okay, this is the first part. The second part is giving a detailed picture of the business, but in particular examine the liquidity of each item in the current assets. For instance, examine the liquidity of the account receivable and inventory. Okay, so this is the 2 overall liquidity, the general picture of the liquidity, and for specific assets, in particular the account receivable and the inventory. Now, how we can calculate liquidity in general. We have 2 main ratios. The first one is the current ratio analysis, and the second one is the asset ratio analysis. Let's start by the first one. The first one is the current assets divided by the current liabilities. So the results is like this. This is the optimum one is 2 to 1. It means 2 current assets and 1 is current liabilities. It means $2 in the current assets covers $1 in the current liabilities, which is fine. If this less than 2, so we may challenge some problems. If it is greater than 2, it's fine, but be careful. We don't need to have excess liquidity or higher liquidity. Okay? Okay, so this is the current ratio analysis. And the example here, if you look at the current assets, 477 divided by 292 current liabilities, go back to the financial statement, you have 1.63. What it means this 1.63, $1 in the current liabilities and $1.63 in the current assets. So it means we can cover $1 of the current assets and we have extra 63. Still, we are not in the safe side because the optimal one or the model is 2. But it is fine, but we may face some challenges. We may. Okay? Any question? بنات ask me يعني اسألوا ايش في عيد السؤال. Look at here. So this is current assets and this is current liabilities. We have 1.63. What it means 1.63? It means the current assets is greater than the current liabilities by 0.63, not by 1 point, because 1.
Yeah.
So 0.63. So if, for instance, if the result is 2, so it means the current asset is greater than the current assets by 1. So we cover 1, then we have additional $1. So in this case, we have 1.63. 1 is 1, and we have 63, additional 63. Which is more secure, having 1.63 or having 2? Yes. Why? Because just if we cover 1, we have saving $1. So we may be more relaxed if we have $1 extra after paying back the $1 of the current liabilities. Now, this problem, this equation or this ratio is, let's say, is misleading. Or because it includes some current assets which is not liquid. For instance, liquid inventory. So the inventory is not liquid asset or the least liquid assets. So what we can do is we want to ensure whether you have liquid assets or not to recover the current liabilities. If I ask you now, can you recover the liabilities now? So what we can do, this current ratio analysis cannot serve us. ما فيش هتخدمنا. So what we can do then to calculate the asset test. acid test analysis, which is called quick ratio. What it means, acid test. Okay, the acid test, when you go to the jewelry, and you have your own gold and go, okay, please test this for me, whether this is real gold or the fake gold. The jewelries, if he has experience, just look at the gold and see, oh, this is fake. But if he or she doesn't have experience, what he can just use the acid test. Put some acids on the gold and see what is if this fake or real. Now, we ask the same question. We have real liquidity or we have fake liquidity. What it means, fake liquidity, it means some items in the current assets have least liquidity. So when we want to liquidate this, we may challenge issues, we may challenge problems. So what we can do in order to calculate the acid test ratio or the quick ratio is current assets minus inventory. Why it is inventory? Because inventory is least liquid assets, divided by the current liabilities. See, the picture now will be changed. So the 470 divided or minus, this is inventory, divided by the current liabilities, we have 0.63. So what it means? Can we recover now? What can we recover the current liabilities? No, we cannot. This is in 2009. So we have problems in recovering the current liabilities. We need at least around 37 cents to recover this. Okay? So look at this problem. But if the firm is clearly less liquid, this is why the current asset, the current ratio is misleading for the business. The firm is clearly less liquid using quick ratio as the firm has only 0.63 in the current assets, less inventory to cover $1 in the current liabilities. So the quick ratio improved in 2010. This ratio is in 2009. So this is why the financial managers decided to improve this ratio, and it becomes 0.94, which is close to 1, which is acceptable. Okay, so let's stop here. Okay, وإن شاء الله نشوفكم بعد العيد ونقول لكم كل عام وانتم بخير.